If gold ever touches $20,000 an ounce, it won't be because of hype, speculation, or some wild internet theory. It will be because the underlying macro conditions forced the system there. And that's the part most investors miss. This isn't really a story about gold. It's a story about debt, monetary decay, and the structural limits of fiat systems. These are the same dynamics Ray Dalio describes in his work on long-term debt cycles, and it is exactly the kind of asymmetric setup Michael Burry would quietly bet on before anyone else is even paying attention. Let's break this down with Wall Street precision. First, let's understand why $20,000 an ounce isn't a fantasy, it's an accounting endpoint. The United States is currently sitting on $37 trillion in federal debt. It's running annual deficits north of $1.5 trillion. The interest expenses on that debt have already exceeded $1.2 trillion and are projected to hit $2 trillion within just 3 years if interest rates stay elevated. This math does not work. Historically, when sovereign nations hit this wall, they don't default outright, that's too chaotic. Instead, they default through the currency. They devalue it. And gold is simply the mirror reflecting that devaluation. A gold price of $20,000 an ounce isn't random. It corresponds to roughly $5 trillion in revalued U.S. gold reserves. And that $5 trillion figure is precisely the amount required to repair the U.S. balance sheet optics, restore confidence in its reserves, and provide the necessary collateral for continued debt issuance. This isn't a prediction, it's balance sheet algebra. Now let's look at the macro setup. There are 3 signals that Bloomberg desks are monitoring daily. 3 structural pressure points pushing gold upward over the long cycle. First is the debt spiral acceleration. The U.S. has to roll over about 30% of its debt every single year. That means higher interest rates feed directly back into higher deficits, which require more debt, creating a vicious cycle. This is classic late cycle debt, overhanging exactly the phase Dalio says leads to currency devaluation. Second is the declining confidence in the dollar system. It's not a secret. Central banks around the world have been net buyers of gold for 13 consecutive years. Countries like China and other emerging markets are actively reducing their exposure to U.S. treasuries. This isn't about being bullish on gold. This is a quiet, slow-motion run on the dominance of the U.S. dollar. Third is long-term monetary dilution. Since the year 2000, the M2 money supply has increased by roughly 600%, and the supply of gold. It has grown by a mere 1.6% annually. One is exponential, the other is linear. In systems like this, a revaluation isn't a matter of if, but when. So, how does a serious Wall Street portfolio prepare for a high gold world? This is where someone like Burry would lean in, and Dalio would diversify aggressively. There are 3 pillars to a sophisticated approach. The first pillar is physical gold, the ultimate collateral asset. A physical allocation acts as the antifragile core of your portfolio. This isn't a trade, it's insurance. It's collateral against sovereign-level currency. Debasement institutions typically hold between 5 to 15%. For individuals in high-risk environments, 10 to 20% is a typical allocation. The second pillar is gold ETFs, which serve as the liquidity sleeve. Think of the SPDR Gold Trust, GLD, or the iShares Gold Trust, IAU. Institutions use these for instant entry and exit, for portfolio hedging, and to avoid storage risks and logistical burdens. They offer tight spreads and clean, tactical exposure without operational headaches. This is the Bloomberg terminal, weapon fast and efficient. The third pillar is where the real asymmetric upside lies, mining equities. This is where Michael Burry's keen eye for convexity shines. Historically, mining stocks show 3 to 5 times leverage against gold price movements. Why? Because their costs are relatively fixed. If the price of gold doubles, their profits don't just double, they can quadruple or more. If a currency crisis forces gold to 10 times its current price, miners could re-rate by 25 or even 50 times. This isn't for conservative capital. This is for investors who understand convexity and want serious torque in their portfolio. Now, let's talk about the behavioral edge. Dollar cost averaging versus market timing. Professional investors don't try to time major macro turning points. They accumulate dollar cost. Averaging isn't some retail trick, it's institutional discipline. And the reason is simple. Long-term macro shifts happen slowly. And then all at once, ask any veteran on Wall Street, and they'll tell you, you do get the price you want when the system is breaking. You get the price the market forces on you. Accumulating over time helps you avoid that trap. You build your position during the calm. Of course, risk management is what truly differentiates the pros from the amateurs. This is where Ray Dalio's philosophy becomes essential. He famously said, know how to suffer well. What does that mean in this context? It means understanding that gold can stagnate for years. It means knowing that mining stocks can collapse 60 to 80% in brutal bear markets. It means recognizing that ETFs follow the spot price but offer no physical protection in a true systemic crisis, and that physical bullion incurs premiums and storage fees. A thesis built around $20,000 gold demands a multi-year horizon and immense emotional resilience. If you're the type to panic on a 15% drawdown, you must size your positions appropriately. You have to be able to withstand the volatility to see the thesis through. The key insight, the one that underpins everything we've discussed, is this. This isn't about gold. It's about the system. When currencies enter the late phases of a debt supercycle, governments always reach for financial repression. Central banks dilute purchasing power to manage the debt load. Sovereign debt becomes mathematically unserviceable under normal conditions. And as this happens, capital quietly migrates from financial assets to hard assets. Gold doesn't go up. The currency it's priced in goes down. That is the fundamental Bloomberg tier insight. This brings us to the real reason to prepare, not to predict. No intelligent person in finance is out there definitively predicting $20,000 gold. Wall Street doesn't operate on predictions. It operates on risk-adjusted positioning. Think about it this way. If gold stays flat, a well-structured portfolio remains stable. If gold doubles, your insurance policy pays off handsomely. And if gold experiences a systemic repricing due to a currency crisis, you are positioned on the right side of history. This is exactly how Dalio built his all-weather fund. It's how Burry positioned for the 2008 financial crisis. It's how institutions have hedged sovereign risk for centuries. So, let's summarize the Wall Street take. Gold at $20,000 is not a forecast. It's a regime change scenario, a mathematical possibility anchored in structural debt, long-term cycles, and inevitable monetary dilution. Smart investors don't wait for the crisis to hit the headlines. They position themselves during the calm, because the revaluation always happens after the system breaks, not before. If you want to think like Dalio or Burry, the question isn't, will gold hit $20,000? The real question, the one that matters for your future, is, what happens to your portfolio if it doesn't? You weren't prepared. That's the entire thesis. Thanks for watching, and be sure to subscribe for more deep dives into the forces shaping our financial world.